my name is Nurul Wahidah Binti Halid. I would like to present Chapter 1. Chapter 1 is Introduction to Financial Management. Definition of Financial Management. Financial management is concerned with raising financial resources and their effective utilization towards achieving the organizational goals. Three main areas in finance. First, managerial finance. Managerial finance is concerned with the duties of the financial manager in the business firm. Second, financial market. Financial market is referred to marketplace where buyer and seller participate in the trade. Third, investment. Investment is commitment of a person's funds to derive future income or appreciation in the value of their capital. Goal of an organization. The goal of a firm is to maximize the shareholders' worth through maximizing the price of the firm's common stock. The goal of a firm, maximization of shareholder worth with profit maximization. Why not profit maximization? Time horizon. Focus on short-term benefit. Times of return. Ignore the concept of TVM distribution of income. Risk. Less consideration on risk has higher risk will generate more income. 5 of function of a financial manager. First, performing financial analysis. A financial manager must be able to transform financial data into a form that can be used to monitor the firm's financial condition. Second, financial forecasting and planning. A financial manager must be able to estimate the future financing need to support the increase in production capacity. Third, making investment decisions. Determine the amount and composition of current and fixed assets needed to be held by the firm to run its business activities. Next, assets management decision. A financial manager must manage the firm asset efficiently to ensure that the firm gets most benefit out this asset. Lastly, financial decision. Doing in-depth analysis of all the available financing alternatives, their cost and their long-run application on the firm financial condition. Definition of financial markets. It is a marketplace in which people buy and sell financial assets such as bonds, equities, and derivatives. It can be divided into two markets, namely money markets and capital markets. Money market with capital markets. Money market is a financial market to raise short-term financing in which short-term instruments with high liquidity are being traded. Example is treasury bills, commercial paper, and bankers' acceptance. Capital markets. Financial market for buying and selling of long-term debt and equity securities. The market can be divided into primary and secondary markets. Primary market with secondary market. Primary market is deal with newly issued security that investors, the issuer and the investor, serve as a venue to raise funds. Secondary markets deal with securities previously issued, provide means of liquidity to investor to dispose share.
Hi and Assalamualaikum. My name is Siti Norshafini, Binti Muhamad Rosli. So now I want to present chapter 2, which is depreciation and taxation. Before I start, I want to tell the meaning of depreciation. Okay, depreciation means the process of allocating the cost of fixed asset over its estimated useful life. A non-cash expenses whereby it is just recognition of the expenses as the asset is used over time. For example, you bought your iPhone on 2010 at price on 1,000 ringgit. Then you decide to resell the iPhone away on 2014. So the question, do you think your iPhone is above 1,000 ringgit? Obviously not, right? Because maybe the price is only 400 ringgit. This is what mean by depreciation. Do you see from 1,000 ringgit to 400 ringgit? Next, we have three methods of depreciation. First, straight line method. Second, double declining balance method. Third, sum of the year digit method. So I only explain two methods only, which are straight line method and double declining balance method. Before start, we will see the example question first. Wafia sendirian Berhad had purchased a deep sea fishing boat with the following financial institution. Purchase price 105,000 ringgit, transportation 3,000, installation 2,000, miscellaneous expenses 300, useful life 5 years, salvage value 10,000. Before continue the method, we need to calculate COA, cost of asset first. COA equal purchase price plus other expenses. COA equal 105,000 ringgit plus 3,000 plus 2,000 equal 110,000 ringgit. Why miscellaneous expenses not include to calculate COA? Because you see the first note that any cost less than 500 not include to calculate COA. So the amount miscellaneous expenses just 300 ringgit only. Second, when the question mentions staff training, that cost not include in calculate COA. Alright, we go to the first method, which is straight line method. This method is very easy and its depreciation same every year. So annual depreciation equals COA minus salvage value divided N. N means useful life. So 110,000 is amount of COA that we calculate just now, minus salvage value 10,000 divided useful life 5 years equal to 20,000 ringgit. Every year the annual depreciation same amount, which is 20,000 ringgit only. This is the table depreciation and it is a format table for each method lah. Just the amount in the table in different value. Alright, remember that the first beginning value always start with COA for each method. Then annual depreciation is 20,000 same every year. Then accumulated depreciation for the first year same with annual depreciation the first year. But second year, to calculate accumulated depreciation, you should plus with accumulated depreciation past year with annual depreciation the second year. Example, 20,000 plus 20,000 and the answer 40,000, right? And then how to calculate book value, you can see the note below that BV equals COA minus accumulated depreciation. Example, 110,000 minus 20,000 ringgit equal 19,000 ringgit. Then BV the first year carry forward to second year. So in other years, using only the same way, then you should remember that BV value in the last year should same with salvage value, it is 10,000 ringgit. Next method is double declining balance method. To calculate DDBM rates equal 1 divided N useful life times 2. For example, 1 divided 5. 5 is 5 years times 2. Why 2? Because double, okay, equal 0.4 or 40%. So this method we must to calculate annual depreciation. How? Alright, annual depreciation equal beginning value times DDBM rates. To make it easier for us to calculate, we should look at the table first. So the first beginning value always to start with COA. It is mean 110,000 ringgit. Okay, how to calculate annual depreciation? The beginning value times the DDBM rate, which is 40% that we calculate just now. Okay, accumulated the first year still same with its annual depreciation, and the BV still same with the straight line method. Then the book value, first year you carry and forward to year 2. Then to find annual depreciation, you must to times with 40%. Then accumulated depreciation equal accumulated depreciation first year plus with annual depreciation year 2, and you can use same way to calculate until the year 5. You have to be careful because book value at the last year will not always be same as service value, which is 10,000. It is not get 10,000, so we need to do adjustment. So this is one is adjusted table DDBM schedule. We need to take the last 2 years to make the adjustment. Okay, book value year 3, you carry forward to beginning value year 4, then at annual depreciation, we need to make adjustment. For example, from this table, book value year 4 minus service value divided 2. Why 2? Because value to be divided equally between year 4 and year 5. So 23,760 minus 10,000 divided 2 equals 6,880. Then annual depreciation of year 4 and 5 use the same value. Next, accumulated depreciation 86,240 plus 6,880 equals 93,120, and you must to calculate the same way to year 5. Then the last book value, you will get the same value as the service value, which is 10,000.
Assalamualaikum and hi, my name is Norshafini bin Abdul Rahman. I am from MBA1194A. Now I will continue the chapter 4 which titled Risk and Return Relationship. Risk. Risk the potential of unexpected event to occur. Return. Return is the reward we expect to get from investment. Now I want to show you the example question of this chapter. Dizzy Berhad is considering the following two projects in different market conditions. They have two tables, which is Project A and Project B. For Project A, the probability for good is 0.5, probability for average is 0.35, probability for bad is 0.15. Okay, rate of return. Rate of return for good is 9, rate of return for average is 14, rate of return for bad is 18. Okay, next for Project B, probability for good is 0.5, probability for average is 0.35, probability for bad is 0.15. Okay, rate of return. Rate of return for good is 12, rate of return for average 28, and last rate of return for bad is 17. Okay, move on the question. The question is for both projects. Determine the expected return, variance, standard deviation, and coefficient of variation. Okay, expected return. The formula of expected return is probability times return. For project A, first 0.5 times 9 equals 4.5, second 0.35 times 14 equals 4.9, third 0.15 times 18 equals 2.7. The total expected return of project A is 4.5 plus 4.9 plus 2.7 equals 12.1. For project B, the same formula. First 0.5 times 12 equals 6, second 0.35 times 29 equals 10.15, and last 0.15 times 17 equals 2.55. The total expected return of project B is 6 plus 0.15 plus 2.55 equal 18.7. Okay, net variance. The formula of variance is probability times bracket return minus expected return bracket power up to. For project A, first 0.5 bracket 9 minus 12.1 bracket power up to equal 4.81. Second 0.35 bracket 14 minus 12.1 bracket power up to equal 1.26. Third 0.15 bracket 18 minus 12.1 bracket power up to equal 2.22. The total variance of project A is for 4.81 81 plus 1.26 plus 5.22 equal 11.29. For project B, the same formula. First, 0.5 bracket 12 minus 18.7 bracket power of 2 equal 22.45. Second, 0.35 bracket 29 minus 18.7 bracket power of 2 equal 27.30. And last, 0.15 bracket 17 minus 18.7 bracket power of 2 equal 0.43. So the total variance of project B is 22.45 plus 27.30 plus 0.43 equal 16.01. Okay, next, standard deviation. The formula for standard deviation is square root variation. For project A equal square root 11.29 equal 3.36. For project B is square root 16.01 equal 7.74. And last question, the coefficient of variation. The formula for coefficient of variation is standard deviation divide expected return. Okay, for the project A equal 3.36 divide 12.1 equal 0.38 times. And for the project B, 7.74 divide 18.7 equal 0.41 times. Okay, that's all for me. Thank you.
Hi and Assalamualaikum. My name is Muhamad Azfar bin Aswadi from MBA1194A, and I want to present to you about Chapter 5, Cost of Capital. Sources of long-term financing. There are three sources of long-term financing: debt or bond, preferred stock, and common equity. These are the sources of long-term financing in terms of definition, maturity period, maturity value, and so on. What are weighted average cost of capital WACC and weighted marginal cost of capital WMCC? Weighted average cost of capital is a method used to find the overall cost of financing through the combination of at least two sources of financing, and proportionate weight is assigned to each sources of financing. Weight marginal cost of capital is a method used to find the cost of capital when an additional amount of capital is raised. Lender may increase the cost of debt when the debt amount exceeds certain limit. WMCC is the WACC applicable to the next of the total new financing. Related to the concept is the breakpoint concept. WACC may change over time due to the changes in the volume of financing. This occurs as the volume of financing increases, the risk increases, and providers of funds require higher return on the funds that they make available. Combination of sources of financing versus single source of financing. Each sources of financing has its advantages and disadvantages. Debt financing, for example, is cheaper than equity financing because the debt financing is tax deductible. However, equity financing is less risky as compared to debt financing. Therefore, the combination of both sources of financing will help a company to reduce its financial risk. Calculation of cost of each sources of financing. Calculation of bond. The formula is KB equal to coupon rate times par value of 1000 plus par value of 1000 minus in parentheses selling price minus floating cost divided by number of years divided by par value of 1000 plus in parentheses selling price minus floating cost divided by 2 or K bar equal KB times in parentheses 1 minus tax. Calculation of common equity. The formula is KC equal expected dividend divided by selling price minus floating cost plus growth rate. How to find D1? To find D1, last year's dividend in parentheses 1 plus growth rate or KRE equal to KC in parentheses 1 minus personal tax rate in parentheses 1 minus brokerage fee. Let's look at example question, shall we? Here are the example question. Step 1 and 2, calculate cost of capital and arrange each cost according to financing limit. Step 3, find book value weight of each source of financing. Step 4, find the breaking point. That is, BP of each sources equal to cut-off point of each sources divided by weight of each source. Step 5. Determine the range of financing based on breaking point in ascending order. Step 6. Find the WMCC for each range of financing. Step 7. Arrange the project according to the descending IRR and calculate the accumulated cost. Step 8. Plot a graph. The last step, step 9. Choose the project in which IRR over WMCC.
Hi, Assalamualaikum. My name is Muhamad Azhan bin Hassbullah. I want to talk a little bit about chapter 6, which is operating leverage and break-even analysis. Start with what are the fixed operating costs. Fixed operating cost does not vary proportional with the level of sale. It remains relatively constant regardless of the increase in the sale volume. Next, about variable operating cost. Variable operating cost, it moves directly with the level of output. The cost increase as output increase. Next is operating leverage. Operating leverage is the responsiveness of earning before interest and taxes added to the change of sales volume due to the use of fixed costs by the firm. Move on to degree of operating leverage. Degree of operating leverage is the percentage change in EBIT resulting from a percentage change in sales. 3 formula to measure the degree of operating leverage. First, your equal percent change in EBIT divided by percent change in sales. Second, DOL equal sales minus variable cost divided by sales minus variable cost minus fixed cost. Lastly, DOL equal X times P minus V divided by X times P minus V and then minus F. That is the example how to apply the formula. Example 1. Kokoro Construction expects its sales to increase by 15% next year. If this year's sales are 1 million ringgit and the leverage is 1.56, what is the expected level of operating income for next year if this year's operating income is 412,000 ringgit? The answer is DOL equal percent change in EBIT divide percent change in sales. 1.56 equal percent change in EBIT divide by 15%. 23.4% equal percent change in EBIT. EBIT this year equal RM 412,000 ringgit. Then EBIT next year will increase by 23.4. EBIT next year equal 412,000 times 1.234, and the last answer is RM 506,408 ringgit. Lastly is definition of break-even analysis. A break-even analysis is a method used to determine the level of sales that a firm must reach to cover its operating cost. Break-even happen when operating income is equal to 0, which implies that sales revenue are equal to cost. Okay, thank you.